profit. Suppose simply calculate the return. How much the return? Can you calculate? Here return. Can you calculate? Here the projected return. Once they get the make net cash inflow. First, I got to like this. The first this is a net cash inflow. So how much the return? Okay, the question is another. Huh? In the you need the project cost because you cannot compare this cash flow as it is. This 20,000 you are getting 1 year from now. This 15,000 you are getting 2 years from now. This 10,000 3 years from now. So they are in the different time period. So in order to calculate project net present value or the return, you have to adjust this cash flow time difference. So in order to calculate this, in order to adjust this cash flow for the time difference, you should know what is the project required rate of return or what is the project cost of capital. So that is you should know. So that is you have to identify. Then you can discount, adjust these cash flows to the time differences and also risk also there. So then you can calculate net present value. I think the concept is okay. So that is the time value of money. So let's look at the timeline. Because in order to do the calculation, you should know this timeline. Now here you can see, I told you we have to deal with the two processes. One is compounding. The other one is the discounting. What is the compounding? Compounding means if you are going forward in the timeline. So that is the process compounding. If you want to calculate this 20,000, is you are getting today. If you want to calculate future equivalent value of this 20,000 in 5 years, so the process applicable is compounding. So you have to compound this 20,000 for 5 years. So that is we call translate 20,000 today into its equivalent in the future. So that is that process is compounding. So what is the discounting? Suppose you are getting 20,000 in 5 years in future. So you want to assess the present equivalent value of this 20,000. So then you have to come in back in the timeline. So that process we call discounting. So throughout this topic, throughout this lesson, you have to compound, you have to discount. That's all. Very easy. Yeah, very easy. Right. So this is අපි සිංහලෙන් කියන සංයුක්තකරණය කියන compounding කියන සංයුක්තකරණය, discounting කියන වට්ටම්කරණය. Going forward is compounding, going down or the coming back in the timeline is the discount. So this is the timeline. So you should be able to define this timeline. There are some assumptions in the timeline. I think it is there in the slide also. Normally we use the T, the letter T to denote the time. T equals 0 means today, our decision point. T equals 0 is the today or the decision point. T equal 1 means 1 year from today. T equal to 2 years from today. So T equal n years from today. So likewise, you can draw this timeline for whatever period. So normally this range, this gap indicates some time period. It can be a year, day, week, quarter, whatever. If it is a year, so this is the beginning of year 1. This is the ending point of year 1. Suppose this gap, this period, so then you can define this is beginning of 3rd year. Understanding, right? This is the beginning of 3rd year. This is end of the 3rd year. So likewise, you can define. So this is the 4th year. So this is the beginning of year 4. This is end of year 4. Right? So you should be able to define the timeline like this. And also in addition to that, there are some assumptions in the timeline. You can see cash flow occur at the end of the interval. This is default. Normally, when you are doing the calculations, if it is not clearly mentioned, this cash flow occurred at the beginning of the period, the default case is cash flows occurred end of the period. So that is first, suppose this is 1,000 cash flows timeline. So first 1,000 cash flow occurred end of year 1, end of year 2, end of year 3, end of year 4. So likewise, that is the default. එක default එක අපි සාමාන්‍යයෙන් assume කරනවා cash flow එකක් ඇති වෙන්නේ කාල පරිච්ඡේදයේ අවසානයේ. So that is assumption. So in default, cash flows occurred at the end of the period. Now suppose like this, you are taking a bank loan today. So your first installment is due 1 month from today. The timeline එක පටන් ගන්න අද. You are taking a loan. So then bank calculate the loan installment. So your first installment, normally you are paying 1 month from today. So cash flows occurred at the end of the period. So that is the meaning. And the other thing is, cash inflows and outflows both can be there. So normally inflows is a positive one. If it is a investment, it is a negative cash flow. Last assumption, compounding frequency same as the cash flow frequency. You might not be able to understand this assumption now, but anyway, we are discuss the more frequent compounding after this, so you will understand. What is the meaning of that? Normally, compounding frequency should equal to the cash flow frequency. Say for the example like this, suppose you are investing some money in a savings account month. You are depositing some money in a savings account monthly at the end of each month. So your cash flow frequency per year, how much? For a year? Cash flow frequency? 12. Monthly. So at the end of each month, you deposit some money. So your cash flow frequency is 12. So this assumption says that compounding frequency should be equal to the cash flow frequency. When you are calculating future value of this investment, so you have to compound this cash flow same as the cash flow frequency. So that means you have to compound 12 times per year. That is the meaning. You will understand. Right? So this is normally given. Cash flow frequency, compounding frequency should be equal. So these are the assumptions of the timeline. Any clarification on the timeline? සමහර අය බුදි. ඒ මොකද? Indian red t-shirt. Villa. ඉතින් අපුණ යමකින් මේ ඔයාලගේ නම් දෙකවසරගේ ලෙක්චර් එක නෝන් මේ කරන්නේ. අර ඔයාලගේ කැන්සල් නම්. Right. Any clarification on the assumption? Any questions? But සාමාන්‍යයෙන් නම් මතක තියෙන දේ ඔය ගොඩක් ලස්සන වාක්‍ය මතක ඒක ලස්සනයි මට මතක. But it's tell me. What's the meaning of that? No idea. ඊළඟ ප්‍රශ්නේ කොට අම්මයි අක්කමගේ තාත්තයන්ගේ මොකක්ද ළමයි තේරෙන්නේ. Right? ඉතින් මම මොකද තාපයි. What is the meaning? Tell me. Okay. Right. So let's go to then type of cash flows. So we discuss basically these three types of cash flows. Single cash flow. What is the single cash flow? Single cash flow means it is like this. You have only one cash flow. Say in your timeline, there is a, suppose you invest some money. Suppose this is your timeline 0, 1, 2, 3. So at the beginning of today or at the decision point or today, you deposit 1,000 rupees. So that is a single cash flow. No any other cash flow. So in the single cash flow, future value, present value with the more frequent compounding, we are going to discuss. So this is single cash flow. If you deposit some money in a savings account or whatever account for a long period, so it is a single cash flow. So we have only one cash flow. Then multiple uneven cash flow mean, so you can see at the its meaning suggests. So you have more than one cash flows. They are unequal. Suppose 1 year, end of 1 year from now, 1,000. End of 2 years from now, 1,500. End of 3 years from now, 2,000, 5,000. So this is more than one uneven. Can I have practical example for this multiple uneven type cash flows? Your telephone bill, electricity bill. These are not even no, based on the consumption that is changing. So that is a multiple uneven type cash. And the other one is annuity. So annuity means in a same duration, if you are receiving a type of cash flow are even. Suppose end of year 1, you are getting 5,000. End of year 2, you are getting 5,000. End of year 3, 5,000. End of year 4, also 5,000. So this is we call annuity. Example for the annuity. Rent, yes. Rent is normally for a certain period is fixed. So that is the annuity. And also bank loan installment. Suppose once you get the bank loan, bank calculating installment. So at the end of every month, you are deposit that installment. So that is a kind of a annuity. So that is also example. In the annuities, there is a type due, ordinary. So likewise, we are discussed them. So these are the main three categories of cash flow. So we are going to calculate future value, present value for the different type of cash flows. Right. So now we are going to the first one, future value of the single cash flow. Right. Now I will give the exercise. Suppose you invest 1,000 rupees in a investment account or a savings account. 1,000 rupees, right? 1,000 rupees in a savings account, which pays 10% interest per month. For your understanding, just take this as a 10% per month, right? Normally, another day for you to understand, right? You are getting 10%. Take this 10% per annum, right? Compounding annually. I need to know what is the value of your account at the end of 5 years. You have deposit 10,000 in a savings account, which pays 10% interest per annum. 10% interest per annum. So what is the balance in your account end of year 5? What is the answer? 15,000. How is that? 15,000. Yeah. What is the 1,600? 10. 1,610. Why? 40. What else? Same. Any other different answer? Same. Huh? So you are investing 1,000, 10% interest per annum for 5 years. So you are getting how many interest? 500. Right? Again, see there, 500. So you have invested here 1,000. So at the end of year 5, you are getting 1,500. Anyone who get this answer? A bank. Is it correct? Why not? Huh? Yes. Yes, this is your investment period. Throughout this investment period in finance, very important function is there, reinvestment. Reinvestment is happening through your investment period. So you are getting 10% interest per annum. You are good. 10% interest per annum. So if you draw the timeline here, so 1, 2, 3, 4, 5. So likewise, so today you have deposit 1,000 rupees. Okay? So at the end of year 1, for this 1,000, you are getting 10%. So 1,000 into 10% means 100. So you will get the interest of 100. So your invested amount is 1,000. So at the end of year 1, you are getting 1,100. So then year 2, beginning balance of the account 1,100. Now bank is calculating interest not only this 1,000, for this interest, year 1 interest also you are getting some interest. Interest not interest. A simple interest neither. There simple interest in finance, we calculate compounded value. Right? So this is the reinvestment is there, compounding value we are calculating. So now for this 1,100, you are getting how much the 10% interest? 110. 110. So then you will get 1,210. Is it correct? Okay. So then this is the beginning year 3. So you are getting now interest how much? 121. So then how much the ending balance at the end of year 3? 1,331. So this is the beginning balance year 4. So now you are getting interest 133.1. 133.1. So then you will have how much? 1,464. So this is the beginning balance year 4, 1,464. 64. For that, you are getting 10%, 146.4. So then at the end of this year 5, you will get 1610.5. This is the answer. This is we call, now here, this investment period, that's the reinvestment assumption. So this is the way of calculating compounding value. This is what the banks are doing. Right? This is what the banks are doing. So you can see throughout this 5 years, there is assumption this 10% interest remain constant. අපි assumption එකම මේක හදන්න but in the practice it is different. Interest rate is changing. It is market interest rate going up and down. But in here always we assume constant interest rate. But if the interest rate change, so you have to consider that. So then this period if interest change, so then you have to take the interest on that rate. So likewise you have to consider. So this is we call compounding process. How the 15th of life? So you have calculated simple limits. That is wrong. If you look at your savings account, savings book, you can see now banks is interest calculated like this. If I ask you to calculate what is the balance at the end of year 20, doing manually like this is not possible. So therefore, we have a formula. In the time value of money lesson, we have 4 time value tables. In your banks, are you using the time value tables? Huh? Here are the tables. Yes, there are 4 tables. I will explain them. This is the future value. Now look at the definition. Future value is the total of the principal amount and interest accumulated on the principal for a given period. So that is the future value. In the second definition, we are deriving formula. It is the sum which initial amount for the initial investment expected to grow over given period. So then based on this second definition, we write the formula to calculate the future value. Future value for any end period is equal is the sum which initial amount or the present value. So our initial amount, present value, expected to grow. So then 1 plus R in given end period into the power n. So if you apply this formula here, our present or the current investment 1000. Our growth rate here 10%. So 1.1 into the power 5. Into the power 5. So you are getting this answer. You are getting this answer. Now in 20 years, what is the value? Suppose interest rate remain constant. Already ගණන් අමාරුනේ මොකද හැම interest rate එක constant යන්නේ. Variable interest rate මේකලදී කතා කරන්නේ. It is that was quite that. So for the understanding of the concept, always we consider the constant interest. What is the value in 20 years? Then our calculator එක ඕන වෙනවා. නේ? ඔක ගන්න පුළුවන් link එක පවපේ. කීයද? 10,000. 6,000. 6,727. So this will be the value in 20. So you can plan financial target. Suppose you want some money in 10 years. So you can decide how much you have to invest in a possible interest rate of on average 10%. නිකන් මේ ගානට market එක ගියොත් කොච්චරක් ඔයා invest කරන්න ඕනද? So you can plan your financial goals. So this is the future value of single cash flow. Future value of single cash flow. So our formula is now we are applying the formula. Our formula is future value for any end period is equal present value into 1 plus R into the power n. R is the cross rate, or our interest rate, or our required rate of return, or our discount factor, or cost of fund, or market going interest rate. Then market personal decision rate or calculate the R what is the R? Look at the market. Look at the market. Look at your opportunity cost of fund. So that is the R. In this formula, this part, 1 plus R into the power n, we defined as future value interest factor at R for n period. Right? 1 plus R into the power n. This term we defined as future value interest factor. Future value interest factor for given R for n period. So this future value interest factor, you can calculate either using this formula or you can use future value interest factor time value table. I told you we have 4 tables. So this is the number 1. So you can go to here. This is present value. No, this is, yes, this is the table. Single future value interest factor for single cash flow. From the internet, you can download this. If you go to any financial management textbook, at the end of the textbook, these 4 tables are there. Now, in our question, now how to read this table? Very easy. Our interest rate is 10%. So you can see the column wise, there is the different rates, rate of returns. So here you can see row wise period, years. So here, what is the future value interest factor? So this is 10% for 20 years. So this is the column. So you have to go here up to 10. What is the factor? Is it this one? 6.7275. So you are getting this, you should get the same answer. You can use the time value table also. This is a single, very simple formula. You can calculate future value interest factor using formula. But in the annuities, my formula difficult. So then you can go to the time value table. From the time value table, you can extract the factor. Banks වල එක තමයි කරන්නේ. නේ? Installment එක calculate කරලා දෙනවා. අපි ඉතින් magic card එකේ කරා කියනවා. දැන් අර එක ඉක්මනට පස්සේ installment එක වලට calculate කරනවා. By using this time value factors. Right? So this is the table. So you can see, you can download this one. This is the table number 1. Any question? Right. What is it? Yes, you can do it. If you deposit 500,000 in account which pay 10% per annum compounded annually. 10% per annum compounded annually. New term, right? Compounded annually. So this is compounding annually. Interest එක ගෙවන්නේ අවුරුද්දකට එකපාරයි. That is the meaning. Compounded annually mean interest per annum. What? How much would you have in the account after 1 year? How much is? 500 into 1.1. හදන්න. කියදන්නේ 550,000. So you can apply 550,000. Right. Now here, this is the table factor extracted from the table for 10% for 10 years. මෙතන 10 උත් තියෙනවා පේන්නේ නැහැ. For 10 years. So this is future value interest factor. අපි සිංහලෙන් කියනවා මේකට future value interest factor අනාගත වටිනාකම් පොලි සාධකය. Future value interest factor for a single cash flow. Right. Now this is by using this table, if I ask a question, the rate here 10%. If you deposit 1 rupee today at the rate of return of the 10%, how much would you have at the end of 8 years? If you deposit 1 rupee at rate of 10%, how much would you have end of 8 years? By looking at these future value interest factors, you can tell. If you deposit 1 rupee, normally this table factor gives you for the 1 rupee. එක රුපියකට තමයි table factor එක හදලා තියෙන්නේ. එතකොට අපි amount එක වැඩි කරලා තමයි අපේ ගාන හොයා ගන්න ඕන. So if you deposit 1 rupee in account which pay 10% interest, how much you would have at the end of 8 years? You will have 2.14. If you deposit 100,000, multiply this by the factor. So you can see over the time, these future value interest factors are increasing. Over the time, these future value interest factors are increasing because of the compounding impact, because of the reinvestment assumption, because the process here compounding. Future value calculation process is the compounding 1 plus r into the power n. So therefore, you can see this diagram. This shows us the relationship between time, interest rate, future value factor, interest factor. Am I fast? Anyone is there? Feel like I'm fasting because mama tika fast kara kare ke kaya han. Awulan nani? Huh? Right. So now you can see the here this diagram shows the relationship between time, interest rate, and future value interest factor. So different interest rate. If interest rate is 10%, sorry, 0%. If you deposit 1 rupee here, this is 1, 2, 3, 4. So likewise. If you deposit 1, no interest. So you can see there is no growth. Over the time, it remains as same. If you deposit at 5%, this 5% is the red line, 10% is the yellow one, 15 is this purple one. So you can see the growth. So what is the relationship having here? Time, interest rate, and the future value interest factor. So future value interest factor is equal 1 plus r into the power n. Take a future value interest factor. This is the future value interest factor. So future value interest factor is equal 1 plus r into the power n. So what is the relationship? When the n is increasing, what happens to the factor? When the time is increasing, what happens to the factor? It is increasing. When the r is increasing, factor is increasing. So that relationship is shows. So you can see at the 15%, this is say in 10 years. If you draw a line like this, so at 10%, this is the future value interest factor, not less than 10, right? So you can see this is the future value interest factor. At 5%, this is the factor. So 0 no. If it is 15%, here factor. So that's the positive relationship. You can understand it because there is the 1 plus r into the power n multiplication. So therefore, when the rate is increasing, factor is increasing. When the time is increasing, factor is increasing. So there is a positive relationship between time, interest factor, interest rate, and future value interest factor. I think you can understand it. Right. Now we are going to more frequent compound. I'm asking question from our bank. How much the interest rate for the normal savings account? 2.7 per annum. So normally interest is calculated on. So that means for annum, you are getting interest 12 times for your account. So that is the value. So that is the more frequent compound. So normally, though we calculate here interest annually, that is not happening in the practice. Normally, most of the banks pay interest monthly. People's Bank, Commercial Bank, all like it. From a bank or monthly, normally it's paid monthly. But Sela, take your room. Anyone from the Sela Bank account? Srilanka is a free lunch. They are paying daily bills. Anyway, so normally interest is compounded more than once a year. Right? Now you told that just what is the interest rate? 2 point. Just forget about the 2.7. Interest rate per annum. For understanding, say 12% per annum. Right? Per annum. Per annum. If interest is compounding monthly, per month, how much you will get? 1%. You are getting 1%. So this is the bank interest rate, 12%. When the bank is interest compounding monthly, even though banks say you are getting 12%, if you calculate real true interest rate, is it more than 12% or less than 12%? This is the bank declared indicate interest rate. If you go to the manager and if you ask what is the interest rate today, 12% per annum. But that bank is paying interest monthly. Bank for interest to මාසිකව account එකට දාන්න. So if you calculate your true for the actual interest rate, is it greater than 12% or less than 12%? එයාට මාසිකව පඩිය හම්බෙන්නේ. It is greater than or less than. දෙකයි තියෙන්නේ. එකක් කියලා දාන්න කන්ටෙක්ටිව් එකයි. Is it greater than or less than? If it is a deposit, for sure you are getting more than 12%. Because for the suppose for 1 year, for the January, you are getting 1% interest. When the interest is calculated for the February month, for that 1% interest also you are getting 1%. So likewise, throughout the year you are getting some more interest. Because of this more frequent compounding, as an investor, you will have an advantage. If it is a deposit, if it is a loan, you have a disadvantage. So that is what we call effective interest rate. Effective rate, nominal interest rate and the effective interest rate. So you should be able to calculate your effective interest rate. Effective interest rate is there only when there is a more frequent compounding. Suppose bank pays interest per annum, compounded annually. They can say, how would the interest rate? Is that effective interest rate? No, that's not. Nominal rate is the rate, no effective rate. But if bank pay more interest, compounded more frequently, then you can calculate effective rate. Have you seen when you look in the newspapers? And I'm not sure even what they're about to I'm just asking. Have you seen the advertising fixed deposit? In the advertisement, it is mentioned annual interest rate is this, annual effective rate is this. Have you seen that? That will have in terms. No. That advertisement not is fixed deposit advertisement not annual interest rate is 12%, annual effective rate is 12.2, 12.5. सामान्य अनुपात से 12 सफल अनुपात से 12. So like that's the advertisement. So that is the effective rate. So what is the effective rate? Is the annual percentage yield or true annual compounded interest rate. So effective rate you can calculate when there is a more frequent compound. So let's see how to calculate that. So the nominal interest rate means normal nominal rate, annual percentage rate. So let's go with this example. Right. Find the future value at the end of 1 year. At the end of 1 year, right? Out of the credit. If the present value is 300,000 and the interest rate is 12% per annum, use the following compounding frequencies. annual compounding, semi-annual compounding, quarterly, monthly, daily, continuous compounding. ඊට පස්සේ ඔයාගෙන් අහන ප්‍රශ්නේ තමයි මොකක්ද continuous compounding කියන්නේ. So you have to prepare for that, right? Right. So let's do the first one because annual compounding you have to know that. You learn that. So calculate the now you deposit 300,000 in a savings account which pay 12% per annum. If compounding frequency annual, what is the value at the end of the year? You deposit 300,000. Interest rate 12% per annum. The investment period is 1 year. End of 1 year, we will get 300. Yes. Interest compounded annually, so it means your future value at the end of year 1 is equal. Your deposit is 300,000 into 1 plus R, that is 1.112 into the power n. N is 1. So the answer is 336. So you will get 336. This is the answer. Now the same scenario, but compounding frequency is semi-annual. Semi-annual means what? 6 months per 6 months. If semi-annual compounding is happened, what is the compounding frequency? 2 times per year. Now our formula, we are with adjustment. When more frequent compounding is there, this is the formula. Present value into 1 plus R into the power n. This is our formula. When more frequent compounding occurs, we divide R interest rate from M, multiply n by m. What is the error? M is compounding frequency per year. M is compounding frequency per year. So now it is semi-annual. So now you can calculate. Remember, M is compounding frequency per year. How to do it? Right. If it is semi-annual, we deposit 300,000. So 1 plus R is 12%. R is nominal interest rate. M is 2. So we have to divide it by 2. N is 1. M is 2. The compounding frequency is semi-annual. How much the balance in your account at the end of year 1? Do you have any questions? Any clarifications? Please ask. Questions? Do you have any questions? In its compounding frequency per year, how is the letter? What is the given? Compounding frequency per year. What is the value? The compounding frequency is semi-annual. How much would you have at the end of year? So only thing 12% you have to divide by 2. So that means 6%. Then multiply by the range maker take up it. That's all. 336,000. 337,080. 018. 080. 80. Right. So likewise, we can have now calculate for the other frequencies except for the continuous sum combinator I explained them. Please come into here and explain that. You. Right. Calculate the values for the other frequencies quarterly, monthly, daily, and also weekly. I think there is a table. Fill this. We calculate the future value. Just forget about the effective rate. Fill this. Right? Finish. Everything economic compounding frequency has a certain effect. So you can check your answers. You finish, you can check your answers. So these are the values. At the end of year one, for the different compounding frequencies. You can see semi-annual, we did it. Quarterly, it means compounding frequency for the year, 4 times. Monthly, 12 times. Means weekly, 52 times. Daily, 365. You get this answer? Right. Now, effective rate. So I told you that when there's a more frequent compounding, the true interest rate is not the 12%. So really you are getting more than 12%. Right? So now with the annual compounding, no effective rate, your interest rate also, the return you are getting also 12%. No difference. But it's semi-annual, so you have an effective rate. Right? So that is you can calculate using this formula. Effective yield or the effective rate is equal 1 plus R divided by M, N into M minus 1. Normally this is a rate of return, so you have to multiply by 100. Right? I put it is there 1 plus R divided by M, N into M. From the answer you have to deduct 1. So you know what is M. M is the compounding frequency per year. Remember, in effective rate calculation, this N always is equal to 1. Because effective rate we calculate per annum out of it. So therefore, no need to mention even the same. It is always 1. When you are calculating effective rate for a section, so it is always equal to 1. Right. So let's calculate for the semi-annual compounding. So our effective rate is equal 1 plus R is the nominal interest rate 12% divided by 2. Semi-annual 2 times per year. So N into 2 minus 1. So after you have to multiply by 100, get as a percentage. So this is the effective rate. So we can calculate effective rate When compounded frequency still can be. What do I read with that? Well, why? So your effective rate is semi-annual compounding is happened 12.36. So you are getting extra 0.36 per annum. That is advantage for you. Suppose if it is a law, then it is not take up the other rate. So this is the so calculate for other frequencies quickly. If it is quarterly, if it is monthly, weekly, daily. Calculate the effective rates. Finish. Right. You can check. So what you can see, your observation, when the compounding frequency is increasing, what happens to the compounded future value? When the compounding frequency is increasing, your future value or the compounded value is increasing. So you have a benefit. You're getting more. And also, if you look at then effective rate also in line with the compounding frequency, it is increased. If your interest rate compound daily, you will get 12.75. This is the true. This is the actually you have received 12.75, even though the bank said 12%. So that is you are getting more because of this compounding impact, because of this reinvestment impact. I think now it is clear. Right? Any question? Right. So the next one is continuous compound. What is the continuous compound? What are you saying? I love it. What is the continuous compound? Simply. Every possible place. What is we can search and tell you. Right. Continuous compounding way, if interest is compounded for a short period, the maximum short period is in the nanosecond for a minute. So that is continuously happening. So that is statistically maximum possible limit. That statistics are not explaining the mathematics. That is in the limit theory. It is the maximum possible point. So interest is compounded continuous. Even for a second, nanosecond can so likewise for a tiny or the very small bit of time, even interest is calculated. Now, say for the example, in your credit card, have you experienced it? Suppose your due date is today. You have to pay your balance today. If you delay that payment, normally at the 12 midnight before that time, you have to pay. If it is exceed even 1 minute, you have to pay some payments. So that is continuously compound. That is happening in some credit cards. So that is happening with the continuous. So interest is calculated for a small, tiny time, even for a small point of time. That is continuous compound. So that's some example. So this is happening even in the world. So continuous compounding is happening. Some investments are there, interest are paying continuously. So then when there is a compounding happening continuously, how to calculate future value and the effective rate. So you have to apply statistics here with a continuous compounding. This is our formula. With a continuous compounding, n becomes very large. Right? In this formula, it is the future value. Future value is equal present value into 1 plus r into the power n. into M divided by M. So with the continuous compounding, this M become very large number. Statistically, we say that it is going to infinity. It's approach to the infinity. So therefore, mathematically in the financial mathematics, it is actually proving, but so therefore, M approach to the infinity. So as a result of that, with the continuous compounding, future value is equal. You can see the formula. Future value is equal investment E base Rn. Is a natural consonant. Is a constant value. Always is equal to 2.71828. It is a constant number. So always it is a fixed number. So E base R into N. So that is the future value with the continuous compound. And also effective rate you can calculate with the continuous compounding E base into the power R minus 1. So this is the maximum possible number you can reach. So with the continuous compounding, so therefore future value is equal. Our investment is 300,000. Right? Investment is 300,000. Right? Calculate into E base Rn. So each always 2.71828 into the power Rn. R is 12%, N is 1. If it is 10 years, suppose this investment is 10 years, so then N is 10. Then आप में काउंट होता है, so therefore N 1. If it is 10 years, N is equal to 10. So what is the future value? In 10 years, how it is in from year in at the end of 1 year. What is the answer? Possible? 3,000? Let's see. 36,000. 249. 48 divided by 10 daily calculate. 240. All with the daily, if I compare with the daily compound, so you are getting 4. So then effective rate also we can calculate 2.71828. E base R 12%. From the answer you have to deduct 1. So this is the effective yield or the effective rate in the continuous compounding. With the continuous single continuous compounding, apart sum with the current. Only current. This is the maximum effective rate. It is how much? 12. With the continuous compounding, what is the effective rate? Is it 12.74. Where did it get out? 12.74. अब इसका कितना? 12.75. 74. 78. 490. And the other someone is 490 and that which is 75. Close to that one. Okay, so just exact might be around the errors. So that is the continuous compounding. Right. Okay. So then we got to the present value. So this is the future value. Single cash flow. So now, any question? Do you have any question? Question zero, what is the question? This ಯಾಕೆ ಪ್ರಶ್ನೆ ಉತ್ತರ ನೆನಪಿನ ಕೊಯ್ಲಾಗದಿಂದ now the present value of the single cash flow. Right? So now discounting. Future value is the compounding process. Now present value of the single cash flow. So from this formula, this is the future value equal present value into 1 plus r into the power n. So now present value is equal future value into 1 over 1 plus r into the power n. Or 1 over 1 plus r into the power n, you can write 1 plus r into the power minus n. Minus n. 1 over 1 plus r into the power n, you can write 1 plus r into the power minus n. So this is the present value of the single cash. So here again, this for this part, 1 over 1 plus r into the power n, we define as present value interest factor. Present value interest factor for a given r, given n period. Present value interest factor. Abhi isavante future value interest factor. So this is present value interest factor. So this is our second table, time value table. Right? Present value interest factor table. Now we look at this example. If you receive it 500,000 in 3 years from now, you are getting some 500,000 rupee in 3 years from now. And what is the present value if your interest rate or your cost of fund is 10% per annum? What is the present value? Suppose there is an investment. So you are getting 500,000 in 3 years. So what is the value of this investment today? This is very important in the second valuation. Based on the cash flows, we are calculating present value. So what is the present value? What is the value of this investment today? So you have to apply present value formula. You are getting this 500,000 in 3 years. This is a single cash flow. So you are getting 500,000 in 3 years. Your cost of fund is given 10%. So then in 3 years, so 1.1 into the power minus 3. Or you can take 1 over 1 plus r into the power n. So how much the present value? What is the value of this investment to present to today? Any question? Huh? Are you okay? If you have any question, we can ask them. Any question, no worries. What is the present value? 200, 300, 75,000, 650. So this is the present value. I think it is correct. 375,657. So if you are going to sell this investment to another investor, suppose this is a kind of investment. You are to be receiving 500 in 3 years. There are many investment you want to sell it. You have a liquidity issue. You need some money. So you are going to sell this investment to a person. What is the maximum? What is the maximum? What is the minimum you are expecting for this investment? What is the minimum value you are expecting if you are going to sell this investment? At least you should have 375,657. You are getting 500,000 in 3 years. In the back. What's only on? So you are going to sell this investment to another person. Right? Your cost of capital 10%. Your required rate of return is 10%. So then you want to decide by how, what is the price, what is the value of this investment. So at the 10% cost of capital, your minimum expected value is 375,650. If you are going to sell, at least you need this. So that is the present value. So in the future, you have to value bonds, debentures, equity shares, preference shares based on this concept. Apply the discounting process. So now our second table. I told you there are 4 tables. Banku තියාගෙන ඉන්නවා ලාච්චුවේ දාගෙන tables 4. මෙයා දන්නේ. ඊළඟ අහන්න core tables කියලා. Right, so this is our second table. This is future value interest factor table. This is the first one. So the next one is present value interest factor for single cash. Table number 2. Now in our example, again same like, right? Columns rates තියෙනවා, rows වලට years දාලා තියෙනවා. So here our rate is 10%. 10%. So this is the column, this one. In 3 years. So what is the present value interest factor? 3 years factor is here then 0.7513. Okay? In 3 years, 0.7513. This is the factor. Simply multiply this 0.7513 from 500,000. See whether you are getting this. The formula factor. So factor is 0.13. So multiply 0.0513 by the 500,000, you will get this answer. So this is the present value. But for the exam, I am not giving you the table. For the exam, no tables. So you have to apply the formula. This is for your understanding, and also not this, even in the Excel, there is a function. I think you have a subject financial modeling in future. So in this modeling subject, you will learn how to calculate future value, present value using the Excel function. If you are using the Excel function, you can calculate these numbers. Are you getting the same answer? We'll get the same answer. What is the getting? Huh? No. I will provide all the formulas. No, tables are not. And that kind of all the animals in the tables. Formula to the mother. I tables. Formula to the huh? Well, they see formulas still they know, no worries. You have to apply the relevant formula. That is the challenge. Annuity है due back ordinary है back. Correct formula you have to apply. Now look at this diagram. Like earlier, if you look at this one, this is table factors. Present value interest factor at 10% for 10 years. Right? So these are present value interest factors. Like earlier, right? In the future value interest factors also, I show you the same type of table. Now, if I ask the question by looking at the table, please answer me. If you are receiving 1 rupee in 8 years, if your cost of fund is 10%, what is the value of this 1 rupee? 0.46 cents. That is the value. So if you look at the last column, what is happening to the value? When the time is goes up, what is happening to the value? Value is decreasing. What is the reason? Mathematically, this is the reason because this is discounting of 1 plus r into the power minus 1. So that is happening discounting. Mathematically, this is the reason. Theoretically, what is the reason? When the time is increasing, present value interest factors are decreasing. What is the reason? Theoretical reason is what? What is the theoretical reason? Yes. You know that. What is the theoretical reason? Because of inflation, because of time value of money. That is our concept. Money receiving today more valuable than money receiving tomorrow. If you are getting that 1 rupee in 1 year, value is 0.90. If you are getting the same 1 rupee in 8 years, value is 0.46. Value is decreasing because of the time value of money. Inflation, risk, all the things are there. Time value of money, reasons. So that is the reason. So the theoretical reason is the concept of time value of money. Over the time, the value of the money value is decreasing. No value. So that is because of the value. Right? So value is decreasing because of the time value of money. In the future value, it is increasing because of the compound. Through the time you are reinvesting, there is the growth of the money. Right? So then it is also the reason is time value of money. So there is a compounding impact in the cash flow. Right, now look at this one. Earlier, this was the diagram. This one. This is future value interest factor. So now this is present value interest factor. So opposite to the previous one. So you can see 0%, 5%, 10%, 15%. So what is happening to the value over the time? Suppose here 10 years. So value at the 15% here. Value at the 10%. So value at the 5% here. So likewise, you can see there is a negative relationship between time, interest rate, and present value interest factor. It is clear. Right? Present value interest factor is equal. Present value interest factor is equal 1 over 1 plus r into the power 10. Okay? Present value interest factor is equal 1 over 1 plus r into the power 8. So there the process is discount. So when trend is increasing, what is happening to the factor? There is a negative relationship mathematically also. When it is increasing, value is decreasing. When the R is increasing, R increasing means this take a value. R value. Then when the R is increasing, value is decreasing. Factor is decreasing. So likewise, there is a negative relationship. You need to go. There is a negative relationship between time discount factor and the present value interest factor. Now, this is the present value of single cash flow. Right. Now, everyone should answer one question based on the discussion after this. I'm starting from somewhere, whatever the question. So then you have to do this. Yes. Based on this discussion. If you need some, if you need time, what is the question? You ask any questions. Related to this discussion. You, what happens to your hand? Excellent. Right. Yes, quickly. Any question? I think the last question. What kind of question? Yes, you. Why not? What's your parallel? Question. Okay, question. You have to ask question from me. But you can look at the time limit one if you are here. Yes, you. This is not a job cut. Yes, read. T-shirt. E. E. That's it. Effectively. Oh, no. This is the 2.71828. This is a natural constant value. Always it is a fixed value. So this is the applied when we are calculating continuous compounding value. It is a natural constant. Always it is a fixed number. Right? While I am calculating a number, always it is 2.71828. That is the unit. Right? Good question. So there is an statistical data. So it is always a fixed number. And whenever you can do it, it's a constant number. Statistical interpretation is there. It is always 2.71828. Yes. Yes. Difference between nominal rate. So effective interest rate you can calculate only when there is a more frequent compounding. Nominal interest rate means normal interest rate and it is per annum. It is normally declared by institutions, banks. It is the nominal interest. Is it correct? Yes, quickly. Yes, it is. What is the meaning of M? M is the compounding frequency per year. When there is a more frequent compounding, normally M we use to define the compounding frequency per year. What happens if payments becomes interest rate is going to zero, there is no growth of the investment. So your investment value will be same for a period. Do you have a question? You know, we have a question to the right? Yes, yes. Sorry. Minus. So normally it is mathematics. 1 over 1 plus r. If you are taken an r, you can write it alternate way. 1 plus r into the power n. Teenage y can take an r to the up to the other plot, take an r to the teenage one. So that is the reason. See the result? Manufacturing industry. So yes, you can use if there is a cash flow, if there is an investment, you can apply either for the manufacturing or the service or whatever distribution, whatever organization. Not influence. It is not depending on the type of industry, type of the products. So we are applying this scheme for the cash flow. Okay. What is expected from you? Same decision. Again, you have to take investment, financing, dividend, working capital. So investments are same. Only difference it is a manufacturing. It is a service organization. Same decision you are taking. Am I correct? If you have doubts, you can ask. I don't know what is the expected. When there are no difference, the formula is same for whatever the type of business. This is we are calculating present value of the some cash flow, future value of the some cash flow. Okay. Your question? Continuous. Continuous compounding means continuous compounding. Compounding for a short, even for a very tiny period of time. So that is happening continuously. So that is statistical application. So if there is a continuous compounding, you can calculate maximum possible length you can reach with a mathematical limit theory. Yes. Yes. Now. Right. Now you learn the more frequent compounding. When the interest is calculated more than once a year, so there will be a more frequent compounding, can be 1, 12, 30, or likewise. So then compounding frequency should always be equal to the cash flow. Cash flow frequency should always equal to the compounding frequency. Now here in your previous calculation, you saw that when the cash flow frequency is 12, M also become 12. I want to explain that one also. Under the assumption, in the timeline assumption, there was assumption, cash flow frequency should be equal to the compounding frequency. That is a norm. That is a norm. Now we apply now compound more frequent compounding. So if you look back, you can see when the compounding frequency is monthly, M is 12. So when you calculate the future value, you multiply it by 1 plus r into the power n into 12. So cash flow frequency type, compounding frequency type, they come as same. If it is a monthly compounding, cash flow frequency 12. After $40 so that is the cash flow frequency. So then when you are calculating the future value, you take 12 as the 1 into 12 as the compounding frequency. So that is the meaning. It is a norm. Minus. What is meaning of that? When you are calculating effective rate, there is a -1 formula. So you are asking that is why. that -1 represents you are deducting your initial investment. So with the effective rate, we are calculating rate of return. We calculate the return rate. The return against the investment is that. So we are deducting 1 represent that. So normally when you are calculating geometric mean, you can remember from the answer you deduct 1. So that 1 is for to represent the investment of the project. The investment of the initial investment. Deduct the cost investment cost. So it's going to return. That is the reason. Compounded frequency. Compounded frequency mean that is per annum. Interest can be calculated monthly, quarterly, daily, weekly. So like that. The interest is calculated quarterly. So you will get interest 4 times per year. It is quarterly, you will get 4 times per year. So that is the compounding frequency per year. Do you have doubts? Cash flow frequency. Cash flow frequency means now it is compounding frequency is quarterly. So you are getting interest 4 times. That is the cash flow frequency. So एकම තමයි අපි compounding frequency විදිහට ගන්න. මේක කියන්නේ function එකේ cash flow frequency එකයි compounding frequency එකයි සමාන වෙනවා. ඒක norm එකක්. So if it is quarterly compounding, cash flow frequency per year 4 times. For year අපි පාස් කරනවා. එතකොට our compounding frequency also should be 4. That is clear. Time value of money is not that. Time value of money is not free from different. So, in the here this rate of return, suppose here 12%, it is included risk-free rate of return plus risk-free. So that 12% we are going with the market, we are going market interest, going market interest. So that 12% not only the risk-free, our risk-free has been given discounted. So that our requirement of return, our cost of fund. So that our, as I beginning I write the formula. So that required rate of return includes risk-free rate of return, that is for the time value of money. Risk-free rate of return can return for the time value plus risk-free. Either we 12% calculate in addition to the premium for the time value, that's the premium for the risk. Both are included. And we get the time value is the register, we get the risk that is not. Our discount factor is risk time adjusted discount factor. Both are included. If you require rate of return samana, risk-free rate plus risk-free rate is what is that? For the time value. අවදානම නැත්නම් ඉතල තියෙන රිටර්න් එක ඔයාගේ කාලයට. ඔයාගේ ඉන්වෙස්ට්මන්ට් එක ගන්න කාලයට. ඒතකොට ඒකට අපි එකතු කරනවා රිස්ක් ප්‍රීමියම්. ඒතකොට අපේ රික්වයර්මන්ට් ඔෆ් රිටර්න් එක ඇතුලේ ප්‍රීමියම් for the time, premium for the risk for okay, අර දෙකේ විතරයි. They know it. Bankers there. Samanyan needs to compound in that. I mean, take a monthly in the money. Well, I don't know what it is. People think it was it. And he is come to weekly come from the 6 deposits on a weekly. Some of it is interest rate weekly compounded in a year. And other some of it is normally 1 month, the minimum is 1 month. weekly hari gaya. हम निकल गए मतलब लेक्चर में मतलब मटेरियल से ऑनलाइन क्लास में भी रहता हुआ but it is very rare I think. I'm not sure. एक very rare. We have that's basically yes to they are like if we don't like maybe or something like that is there a way to calculate to that I mean this when you are not sure about what it can be. Yeah, there are ways. There's the probabilities by identifying the probability distribution of the return by applying the possible probabilities and calculating the expected return, standard deviation, we can focus. There's a way. In the risk and return, we are doing to a certain extent. Okay, good. Well, right. Look at these two cases quickly, so then I think can wind down next. Like, okay, what is the time now? Look at these two applications. If you deposit 250,000 rupees in a savings account that pays interest annually, you will have 380,280.75 cents after 3 years. What is the rate of interest paid by the bank? What is the rate of interest paid by the savings account? That is number one. Two, if you deposit 75,000 rupees in a savings account that pays 15% interest per annum, compounded quarterly, how long will it take for your account to grow? Two, 226,310.4 cents. So this is application of the present value to future value formula. To do this quickly, you can start the multiple cash flow quickly. Do it. This is application of present value, future value of the single cash flow. In the example, you can see only the single cash flow. In the next week, shall we have a quiz on the financial market and environment? Okay. Then that is the quiz number one. 50 question. One. Copyright. So I am shuffling the answers, so therefore you can't copy. You can spread out the uniform and copy on that. There will be. You can take a color. Thanks. If you deposit 250,000 in the savings account, $250,000 in the savings account that pays interest annually, you will have 380,218.75 in 3 years. What is the rate of interest paid by the savings account? So here, you deposit some money, you are getting some amount in 3 years. So what is the implied rate of return? So if you draw the timeline for this, today you deposit 250 in 3 years, you will get this 380, 218.75. This is present value. This is future value. This is the what is missing? Ah. So I am applying the future value formula. Equal present value into 1 plus r into the power 8. So future value here 380,000, 218.75. This is 250,000, 1 plus r into the power 3. So you can simplify the formula by dividing this from 250. You get how much? 1.52. By dividing this into, you get 1.54 is equal 1 plus r into the power 3. Now you can use your calculators. In order to remove the 3, both sides you can multiply by 1 over 3. So here, this 3 there is the cut off which. So 1 over 3 means square root of 3. So your answer will be 1.52 square root of 3, not the normal square root, right? This square root of 3 minus 1 is equal to r. You have to take the square root of 3, right? You have calculated. Do you know how to take it? Take it. Okay. Show me the basic pattern. Oh, that's all. So this is normal square root is fine. This is without videos. We shift this one. Now find the 1.25 5 then 3. Like this way you have to take. If that the previous run. Okay. I think your answer should be 15%. If it is 15%, it is correct. Next one. You have deposited 75,000 in a savings account that pays 15% interest per annum, compounded quarterly. You know what is it? 15% interest per annum, compounded quarterly. How long will it take for your account to grow to 226,310.40 rupees? This is also application of the future value, present value, single cash flow. Finish. So here also we can draw a timeline like this. You have deposited 75,000. 75,000. That pay interest 15% per annum. So annual interest rate is 15%, but compounding quarterly. How long will it take to account for 226,310? 543. So either future value or the present value formula you can apply, but here this annual 15% interest rate compounding quarter. So our formula is this: future value is equal present value into 1 plus R divided by M, N into M. So we have to apply this one because it is a frequent compounding situation. So R divided by M is how much? 15% divided by M. How much the M here? 4. It is 4. So then here then it. There is a below. There is a below. There is a it is a below line. Right? It's not. Right. Now here this in order to simplify this formula, I am using some strategy here. I defined N into M is equal X. I defined this formula. Because I have three variables, so that is complicated. So therefore, I define N into M is equal to X. So now I apply this one. Future value is equal 226,310 or this is 75,000. This is 1.00375 into X. So now we have to solve this for the X. So once you divide 75 by this one by the 75,000, you will get some answer. It is equal 226,310, 75,000 you will count together. And we might see answer 175 equal to this. So now what is the way to apply? Now we have to solve this for this. Sorry. What is the log? So we can apply log. So once you apply the log here, this is log 174. Here, when you apply this one for the log, X. So X log 1.00375. So X is equal this divided by log 1.00375. How much this? Is it 30? So X is 30. So 30 means here quarters. This is the 30. M here 4. If you need to answer in number of years, 30 divided by 4. Approximately 7 years. Yes, approximately 7 years. In quarters, it is 30 quarters you have to wait. If it is in years, 30 divided by 4. And it will take 7 years to draw the 75,000 into 226,310. Okay. So this is very simple calculation for the exam. You will get not like this. Huh? And also, if you look at your tutorial, so you can see there is a tutorial uploaded to the LMS up to question number 10. Now you can do. In this tutorial up to question number 10, you can do. Please do that. Right. So no time to start the multiple uneven cash flow. I think enough, ne? Huh? Right, okay. I think that's enough.